Welcome back. So it's still negative and there is no real sign of buying coming through. Nifty is down now close to 0.8%. You can see it's been a struggle right from, I think, 9:30 onwards. We've not really found much favor in the market. Let's actually pull up the contribution plate. Spoke about the banks earlier. That's, of course, one down leg. But the problem is that there's not too much countering on the other side. On the upside, you only have a few of these tech stocks, IT stocks. Otherwise, look at that. I mean, that's, of course, the Nifty Bank. We'll pull up the Nifty contribution plate as well for you. Nifty Bank is one weak pillar for sure. But there's plenty of weakness in other names. Reliance, Lever, nothing really is adding up today. There you go. Reliance is also taking things down by almost 11 points on the index. Okay, so with that, let's invite our next guest to get us some perspective on the market. Siddhartha Khemka, Head of Retail Research at Motilal Oswal Financial Services, is with us. Siddhartha, thanks for joining in and season's greetings to you. Wish you a Merry Christmas and a Happy New Year in advance. So the market's, of course, gotten into this consolidation. Suddenly, we've been hit by worries, whether it's Omicron, whether it's hawkish central banks. What is your, first, what's the advice right now? Shore up on cash, wait for things to settle, and then take a call in 2 to 3 weeks? Or are you looking to buy every single dip, including the one we're seeing today?
Yeah, very good morning to you, and wish you and the entire CNBC team, the viewers, Merry Christmas and Happy New Year in advance. So if you look at the market, I think the Santa came early this year. In October itself, we hit a new high. And from there, I think, yes, markets have been consolidating. The reasons are very pretty clear that after such a sharp rise over the last almost 20 months, somewhere the fundamentals take precedence, and you have already seen the FIs pulling out, or you can say realigning their weightages across the emerging markets, where India outperformed significantly and now sits at a huge overweight compared to what their model portfolios would have suggested. So they started pulling out, you can say, trimming their exposure in the Indian markets. We saw FI selling in November. In December, that also they continued selling. Last couple of days, it has come down as they enter into the festive, or you can say the holiday mode. Overall, our view on the market remains very positive. After the almost 10% correction from the peaks, we see that Nifty valuation is now in a comfortable zone compared to what we were in October, and it is no longer expensive. So we are definitely looking at gradually adding on any declines from an investor perspective. So if someone has a 1 year, 2 year kind of perspective, it definitely makes sense to start buying on these kind of declines. Because we see that the economic growth recovery to only improve from here on. There are certain issues in the short term, the ones, for example, the Omicron variant impacting, or the bigger issue here is the global inflation and the resultant increasing in the interest rates, the tapering and the decline in the easy liquidity that was available to the market, which only can act as, you can say, speed breakers to the overall bull run that we might see over the next couple of years.
Okay, so keep the faith, buy the dips. The valuations are looking fair at these levels. Siddharth, good to see you, and wishing you a very Merry Christmas. Let's talk about what investors perhaps can look at. One of the spaces which has outperformed has been IT. In fact, this month itself, in the month of December, the Nifty IT index has outperformed the market by close to about 8%. And in that, if you look at the large cap space, TCS has been the underperformer. That's the 1 year performance of the large cap IT names. TCS's gain of 25% pales in comparison to an Infosys, which has rallied 50% in the last 1 year. And Wipro has been the rank outperformer. Siddharth, you believe this TCS underperformance makes it attractive, and therefore you all recently upgraded the stock?
Yeah, Merry Christmas to you, Rima. And so if you look at the IT space, Infosys has been our preferred top pick for more than a year now, and it has done remarkably well, as you highlighted. But after the underperformance of TCS in the last couple of quarters, we now see that that growth coming back into the company. And for the first time in history, TCS is trading at almost 20% discount to the tier 2 players, which was not the case. We always saw TCS trading at a premium valuation, but now that is no more the case. And we all know that the kind of tailwinds this sector is getting, and TCS being the market leader is best positioned to benefit from this structural change, given its organic growth capabilities, diverse vertical presence, geographical presence, and the deal wins that they have been able to garner over the last couple of quarters. So we expect the tailwind to help them deliver 14% revenue CAGR over the next 2 years. And hence, we believe that with growth coming back, the underperformance should now go away. And with the stock trading at a discount, we believe it's a good opportunity to add into a market leader like TCS in the IT space.
All right, Siddharth, thanks for that. But another stock that I saw that you are quite positive on is Godrej Consumer. We've also been talking a fair bit about this, ever since the new MD and CEO Sudhir Sitapati laid out the strategy. So take us through your call on this stock, and how much do you think what kind of target do you have on this stock, and what is the kind of upside that you see here?
So, Pavitra, if you look at the entire market became gung-ho on the company Godrej Consumer once the name of Sudhir Sitapati came in, and the stock rallied much ahead of the person joining the organization. And from there, we saw the stock correcting almost 15-20%. Now, with Mr. Sitapati joining in formally, having the first analyst meet where he's clearly laid out the emphasis on driving growth. The company has focused on getting the double-digit underlying volume growth, which is key essential for any FMCG company that we look at. They have also laid out clear plans on how they intend to gain market share, do some innovations in the products, geographical penetration, product penetration. Even before Mr. Sitapati had joined in, we have seen in the last 18 months how the capital allocation has improved significantly, with ROC touching almost 20% for the first time for Godrej Consumer in almost a decade. So that kind of improvement we have seen in the last couple of months, even before he joined. So now with growth coming back, EBITDA margins guided to be improving by about 150 to 200 basis points, and the stock coming down from its peak, we feel that the valuations are comfortable. The stock is again trading at a discount to its peers in the consumer space, and hence we believe a target price of 1180, valuing the stock at 45 times FY24 P, can give a decent upside from current levels.
Okay, thank you, Siddharth. Happy holidays to you. We'll slip into a very short break on that note. We'll come back with more on the market. Stay tuned.